In the video I recorded for the start of 2025, I relayed how global equity returns in 24 were very high, one of the top 10 years in terms of inflation-adjusted returns since 1928. I also relayed how big years for the market need to be followed by strong earnings growth over the next year if those returns are going to be sustained. So on that front, this year began well. When companies reported their results from the final quarter of last year, they delivered, in aggregate, a really quite pleasant surprise. In turn, analysts revised up their expectations for profits in 2025. Reinforcing this, we had incoming macroeconomic data that continued to be relatively robust, not dazzling, but not concerning either in the round, and certainly not pointing towards recession. We expect rising real wages to continue to fuel household spending growth in most major economies around the world. But in recent weeks, that rather pleasing narrative has been challenged by an onslaught of policy announcements in Washington, D.C. that have increased the risks of lower growth, higher inflation, and higher government deficits, although not necessarily all those things at the same time. The US equity benchmark fell by 10% peak to trough, and US equity markets are underperforming those of the rest of the world, and that's in stark contrast to their relative performance when President Trump launched his trade war in his first term in 2018. Now, in the rest of this video, I'm going to contextualize this correction, re-emphasize that falls of this magnitude are really entirely normal, remind ourselves that predicting politics is a fool's errand, and re-emphasize why we think a well-diversified portfolio of companies that can deliver relatively high returns on capital is the right investment approach for both the long term and during periods of policy uncertainty, better than just buying a highly concentrated index, we think. Now, psychologists have been proving since the 1970s that we are biased to think the past was a less uncertain place than the present. And that's really important to realise when assessing the market outlook after a short, sharp fall, what we euphemistically call a correction. Now, pullbacks of the magnitude we've seen in March are entirely normal. In 28 of the last 60 years, there has been a 10% correction in the US equity market. And in most of them, the full calendar year return still turned out positive. Now, as we propounded in August when equity markets last took a knock of almost this size, investors must assess for sources of systemic stress. So that's banking stress, debt market stress, recession risk, and profit recession risk. And if none are markedly elevated, remain invested because markets rebound often very quickly, again, as we saw last August. Over longer holding periods, equities have nearly always beaten sitting in cash. They're the long-term return driver in our portfolios, so we need to be careful not to shift underweight too easily. And today we do not see elevated markers of systemic stress. Now, ever since President Trump was elected, I've urged the need for humility on the investment community. I've shaken my head figuratively, and I must confess, sometimes literally, at my peers across the industry who have confidently stated that they know what President Trump will do, that he will do this and that he will do that, most of them concluding that it will be positive for US stocks and not so great for everyone else, probably biased by the very recent post-election rally. So in contrast, we confidently said that we do not know what Trump is going to do, and that's okay. Overconfidence is routinely the cause of bad investment decision-making. Don't know isn't a cop-out, there's information in it. It means there is both upside and downside risk. We can account for that, we can model that, we can stress test for that. Investors shouldn't try to second-guess politics because I don't think they're very good at it. You can't predict, but you can prepare is the mantra for how we manage political risks at Rathbones, and we've stolen that from legendary investor Howard Marks. Stress test for portfolios for different outcomes, increase resilience, but don't lose sight of the longer-term trends that really matter for markets in the political noise. Now, of course, we need to consider the potential impact of President Trump's tariff threats and of his administration's plans to cut migration and federal government spending by Elon Musk's Department for Government Efficiency, DOGE. DOGE has precedent. The Clinton administration laid off 426,000 federal workers without causing a recession. A healthy private sector can absorb them. Now, DOGE is trying to go at a more breakneck speed, but because of that, it is hitting pretty severe legal challenges. Tariff plans are flip-flopping almost daily, and there is good evidence that this policy uncertainty alone is likely to cause firms to defer investment spending, but unlikely to the extent that it could cause a recession based on our analysis. In the short term, it's helpful to think of tariffs as a tax increase on imported goods, and as with any tax increase, it's the overall balance of fiscal policy which is important. So with that in mind, House Republicans have just passed a budget plan which would loosen US fiscal policy overall from October, and it's important not to judge the effects of any one government policy in isolation. It's about the round picture. Moreover, it's easy to overrate the importance of politicians to long-term stock market performance. During Trump's first term, he turned US trade policy on its head and started a trade war with China and the EU. He ripped up the Iran nuclear deal. He engineered what at that point was the largest increase in the budget deficit outside of war and recession. He traded insults with North Korea, and he broke Hallow's Convention in his attempts to influence the Federal Reserve. Yet US equity markets performed extremely well over the course of his presidency. Broader economic and market drivers ultimately mattered far more, and US companies continued to grow their earnings rapidly. Trump's corporate tax reform was an additional tailwind. Of course, as ever, we remain highly vigilant for signs of systemic stress. For now, we continue to allocate a substantial proportion of our assets to US equities because the US market has the highest share of firms which score highly on measures of quality. This factor is routinely underappreciated by investors, outperforms during a variety of different economic, financial, and political backdrops, and performs relatively well during historic periods of uncertainty. We believe a well-diversified portfolio of these quality firms is a better strategy than attempting heroically to pick the biggest winners every single year. Now, diversification used to be a strong argument in favor of passive investing, but recently passive investing, which just buys the index, has transformed into a strategy that effectively is attempting to heroically pick the biggest winners because yesterday's biggest winners have become such a large part of the index. The top 10 largest companies in the world now account for 20% of the global benchmark, 36% of the US benchmark. In other words, passive investing is betting that a small number of very large companies that have done well in the past are going to continue to perform best in the future, arguably something passive investing used to argue against in spirit. As I've shown before, businesses often don't stay in the top 10 for long, even if they look completely indomitable at any given point in time. And as you can see from this chart, a near record number of firms have outperformed the passive benchmark so far this year. As I described last time, we still like the UK market for diversification purposes, but all the talk of US exceptionalism, the FTSE 100 has beaten the US market over the last 12 months by a whopping 6% over the last 12 months, including dividends. One of the reasons the US economy has been so exceptional is its government's willingness to take on much more debt. The return of Trump has actually spurred Germany and the EU to take control of its destiny with absolutely enormous funds created for rearmament and infrastructure spending. This is positive for global growth, and on this aspect, the US no longer looks so exceptional. Now, more debt needs to be absorbed by bond markets. It's not a problem in Germany, of course, but high debt is an issue for the borrowing costs of other EU countries as well as the UK. This, together with the inflationary consequences of more government spending as well as a global trade war, has affirmed our call last year to strategically shorten the interest rate sensitivity of the bonds in our portfolios in order to provide a better foil for equity market volatility. So look, there's a lot to digest at the moment. We are highly vigilant of political risk, but our evidence-based, empirically driven process has shown time and again that market corrections are normal, and politics, even Trumpian politics, is more often noise and not signal. Thanks very much for listening.